Welcome to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Here's your host, Grant Bledsoe.
Hello, everybody. Grant Bledsoe here. Welcome back to Grow Money Business. This week's episode is number 96. And this week on the podcast, we double up on the potential tax bill drafted by the House Ways and Means Committee here a couple of weeks ago. There are a lot of substantial changes that would be passed into law if this bill is passed in its current form, which is relatively likely based on what I'm hearing and seeing and reading. At any rate, there are some financial, some tax, some estate planning opportunities that you should probably consider if you're subject to some of these changes. They won't be applicable to everybody, but in this week's episode, I wanted to cover 5 opportunities to consider before the end of the year based on the looming tax bill. I hope you enjoy it.
Hey everybody, real quick before we jump into today's episode, I have been advised by my attorneys to remind you all that none of what you might hear in today or any other episode of Grow Money Business is financial, investing, tax, legal, fitness, or even relationship advice. It's content that you're free to use and deploy on your own terms. And before you take any actions on what we might cover in the show, I really encourage you to consult with your accountant, attorney, or financial planner. If you don't have a financial planner and think that you might need one, be sure to check out threeoakswealth.com to learn more about my firm's planning, advice, and investment services.
Well, last week on the show, we covered in a fair amount of detail the draft of the new piece of tax legislation that was released or published or communicated, I should say, by the House Ways and Means Committee here a couple of weeks ago. And so we dissected it and went through a lot of the provisions that are going to be potentially substantial changes to the way the tax code looks right now, particularly for people earning more than $400,000 per year as single filers, $450,000 a year as married couples filing jointly. This week on the podcast, I want to follow up that episode with a few planning maneuvers and strategies that you should probably consider if you're in a couple of different circumstances in light of this looming tax bill. And so if you've not listened to the previous episode, you might want to go back and run through that quickly, or maybe not so quickly, because there is a lot of technical detail in what we cover, unfortunately. This week, I want to talk about what that means and a few strategies I think that a lot of people out there should probably really strongly consider before the end of the year. So just a little bit of an overview here. Last episode, I talked about why we think it's likely that this particular tax bill, the draft of this tax bill, is more likely to pass in its current form than most pieces of tax legislation that are drafted and published at the committee level. Usually in this legislative process, and again, disclaimer, I am no Washington expert whatsoever, but this is important to our clients, and so it's important for me to bone up on it, and I read a lot of stuff. So people who are a lot smarter on this topic than I am are basically communicating that usually the committee drafts a piece of legislation that is aligned with the theme of the party in power, perhaps the theme of the White House if there's political alignment, and then the draft goes to the floor of that side of the Senate that they're in. So in this case, the House of Representatives. It gets tossed around, negotiated, work is added to it, stuff is taken away. There's all this horse trading that goes on. It gets voted on in that side of Congress, and then it goes over to the other side of Congress, either approved or denied before it gets signed into law, potentially by the president or vetoed, I guess. So in this case, it was drafted by the House Ways and Means Committee. It'll go over to the Senate for approval, assuming that it's passed in the House, and then it would go to President Biden's desk. So usually when it goes to the floor for negotiation, there are a lot of changes that are and adjustments that are made to the original draft. For whatever reason, in this circumstance, the draft of the bill that came out of the House Ways and Means Committee included a lot of provisions we hadn't heard about that were not in President Biden's agenda that he communicated, and other components that were in President Biden's agenda as he communicated them along the campaign trail were not present in this bill. So the speculation here is that those negotiations, that back and forth, already took place behind closed doors before, I guess it would be the majority whip, brought that to the Ways and Means Committee, and then they created the draft of this bill. Again, I'm probably butchering the process and what's actually going on, but suffice it to say that there's a lot of speculation that the bill in its current form is more likely to resemble actual law than most pieces of legislation at this stage in the game. So that being the case, there are some pretty substantial tax changes and things that we should talk about on the podcast as strategies you might want to consider before the end of the year. I'm going to go through 5 that kind of jump off the page at me as maybe not obvious, but things that definitely you might want to think about. Number 1, if you are the owner of an S corporation, the way that the profit distributions from that S corporation will be taxed will likely be different in 2022 and beyond than they are in 2021. As it stands, you have 2 different ways that you get paid out of an S corporation as an owner. If you have $100,000 in revenue and $50,000 in profit, the IRS requires you to pay yourself a W-2 wage commensurate with your efforts in the business. So if you have $50,000 left over at the end of the year, your CPA might recommend that you take maybe $30,000 of it out as a W-2 wage on which you pay payroll taxes on. The other $20,000 that falls to the bottom line, quote unquote, that you might take out as a profit distribution, you don't pay payroll tax on. And that's a pretty nice little benefit. The tax bill that, again, is pretty likely to be passed, we think, has a provision where those profit distributions would not be subject to payroll taxes, just as they're not subject to payroll taxes now, but they would be subject to the net investment income tax of 3.8%. Now, you do pay ordinary income tax on those distributions. It's just not the extra 7.65% for the employer, 7.65% for the employee, or 15.3 when you add it up that you're paying on your W-2 income. So that net investment income tax doesn't kick in until $200,000 or $250,000 of income. But suffice it to say that if you're making more than those amounts, $200,000 as a single filer, $250,000 as a married person filing jointly, where that tax applies, and you own an S corp, and you're taking these profit distributions out each year in a tax advantageous way, well, if you have a bunch of extra cash in the business, well, let me rephrase that. If you have an opportunity to delay expenses or accelerate income into this year, you probably want to think about doing that, because any of that extra cash that's in the account at the end of the year as a pass-through entity, you'll be taxed on, whether you like it or not, whether it stays in the account or you bring it over to your personal account, doesn't matter. And given that it would be subject to an extra 3.8% tax in subsequent years, you probably want to figure out how to do that this year before that takes effect. So that's number 1. Our S corp distributions will be taxed at potentially higher rates. Now, number 2 is not something that I would recommend for everyone. I was just having a discussion with a client about this earlier in the week, and we covered the changes. Long term, the way that long term this opportunity I'm about to describe would be a good idea, but it's a pretty big decision to do that. And so what I'm getting at here is how the changes in estate taxation will come through over the next few months here. As things stand, the first $11.71 million in your estate left after you die are free of any federal estate tax. Anything above that amount, you pay the federal estate tax on, which goes up to 40% pretty rapidly. So the use of trusts is a really common maneuver. There are all sorts of these types of revocable trusts and irrevocable trusts. A revocable trust is included in your estate when you die. You put assets into this trust, you take it back, you have full access to everything while you're living. You can do whatever you want within that trust. The benefit is that anything in the trust does not go through probate when you pass. But because you have access to it while you're living, it's still included in your taxable estate and contributes toward that $11.71 million. Irrevocable trusts are different. You put assets into this irrevocable trust. It's designed to do a specific thing. There's a trustee that you get to choose, but is responsible for handling the assets in the trust, putting things in, taking things out, who gets what after you die, all sorts of things. But once the assets are in the trust, it's very hard to break. And basically, from an estate planning standpoint, it's a helpful mechanism because when you put assets into an irrevocable trust, you're basically getting them out of your estate before they grow substantially in size. And so think about it. If you have a stock portfolio of $10 million, it's a lot of money. But if you have a stock portfolio of 10 million bucks, and if you died tomorrow, your total estate would be just that number, $10 million. So you don't have any real estate or anything else. That $10 million is going to go to your beneficiaries, and your estate is not going to pay any tax on that inheritance because you were less than that 11.71 million. Now, if you give assets to your beneficiaries now, the gift tax doesn't apply until you work through that same 11.71 million. So it's not like you can shell out a bunch of gifts right before you die and then be free of the estate tax. If you give $100,000 to someone, or let's say $1 million to your kids tomorrow, then guess what? The 11.71 million that you have free of estate tax when you die goes down to 10.71. So the gifting and lifetime exemption or credit are basically one in the same. So the idea here is if you think that your estate could be subject to these taxes by the time you die, then you can put them in an irrevocable trust and basically freeze them before they grow in value. So if you're 55 and you've got 10 million in a stock portfolio, you could put that money into the portfolio, in the portfolio into a trust, and that gift reduces your lifetime exemption by $10 million. So you have 1.71 million left to give in your lifetime before any gift or estate tax kicks in. But since you might have 30 years left to live, 30 years from now, that 10 could grow into, 30 or more. And so it's a way to minimize the amount of estate tax that you pay over time. Now, like I said, there are all sorts of variations on this theme of irrevocable trusts. Some of them live in various states. Some of them are meant to assist in charitable giving. There are all sorts of these things. And one of them in particular, this intentionally defective Grantor Trust, is currently allowable in the law, but is on the chopping block based on the draft of this bill. And I covered this last week in a little bit of detail, if I recall. And so the idea here is for income taxation, the rules of what applies, of when income and gains and interest would be taxed at the trust level versus when it would be taxed at the individual level, your level, they're a little bit different than the rules for what's considered part of your taxable estate and what's not. And this difference in definition is where intentionally defective grantor trusts lie. So the idea here is you put the $10 million in one of these intentionally defective grantor trusts, and it's technically out of your estate, but any income from the trust is taxed to you at your personal income tax rates. And the reason that that's beneficial is because trusts have to pay tax on income, earnings, gains, interest, just like we do as individuals. And the rates are identical. The only difference is that it takes a lot less income in a trust to get to that highest tax bracket than it does for us as individuals. And so the benefit, particularly if you live in a no income tax state, is that you set one of these things up, you get the assets out of your estate, but the income is taxed at your personal tax rates, which, again, based on the provisions of this draft, the highest bracket wouldn't kick in until you have $400,000 of income or 450 as a married couple filing jointly. And in a trust, if I recall, I think it's only 100,000 that gets you to that top rate. So that's that option, that opportunity is going away. It's on the chopping block. And so if you're someone who is really trying to do everything within their power to minimize the amount of tax the federal government is going to take out of your estate after you die, then now is the time to call your attorney and at least consider this as an option. The other wrinkle here is this $11.71 million number. And why is it such a weird number, 11.7 million? Well, it used to be $5 million with a little bit added to that every year for inflation. And then it was doubled in the Tax Cut and Jobs Act to 10 million plus inflation. So that inflation number is currently $1.71 million. So that addition, when we went from 5 million to 10 million, was part of the Tax Cut and Jobs Act, which was set to sunset and go away in 2026, if you recall. And so for estate planning purposes, this was always going to happen. The amount of our lifetime credit, the amount that we can bequeath to our kids or beneficiaries or whomever free of estate tax, was always going to go back down to 5, from 10 plus inflation back down to 5 plus inflation in 2026. The current draft of the tax bill accelerates that process and brings it back down to 5 plus inflation starting January 1 of 22. So if you're trying to use this stuff, if it's important to you to minimize the amount of estate tax you're going to pay, if you think that your total estate is going to be worth more than 5 million plus by the time you die, you might want to think about getting a hold of your attorney, because I can guarantee you if your attorney lives in this space, in this field, they're really, really busy right now, and they will be through December 31st. So this is the time to make the call and at least ask for their opinion on whether it would be a good opportunity. Here's where it doesn't make sense. If you don't care as much about the estate tax, if the kids get what they get, which is how a lot of people feel about this, it's a pretty heavy move to take a bunch of your assets and put them in an irrevocable trust. Because unlike a revocable trust, like a living trust or living family trust that a lot of people use to avoid probate, once the assets are in there, you can't take them back. You don't have access to them. If you want to borrow against them, it's hard to do that. It's hard to break that trust and bring it back later. So if you're not sure, don't jump into a decision like that, because it is a relatively heavy move. But if you're set, you've got all the stuff you want and ever need and are not going to have use of any specific asset, it might be a good opportunity. Now, along those same lines, another way that we use trusts and this whole estate planning ecosystem is in family limited partnerships. And so basically a family limited partnership, you have different assets, different trusts. Business owners often use this to hold different business assets and then distribute shares of the group of assets in a specific manner to their kids and potentially the kids' spouses. A little less common to issue them to the kids' spouses, but it's if you have a whole bunch of different businesses of different sizes, the kids are working in them, you're trying to equal out the share. This is a way to put them all into one entity and divvy it up equally across multiple parties. And part of the benefit of doing it in this structure is when you put, let's say you have a family business that's worth $25 million, which is a really valuable business. If you die with that business in your estate, guess what? You take, and you're the only owner, you take 25 million, you subtract 11.71, and whatever is left over is subject to that estate tax of potentially about 40%. And so if you want the business to stay in the family, your kids, your beneficiaries are going to have to pony up a whole bunch of cash to pay that estate tax. And if they want to hang on to the business, they're going to have to come up with the cash from somewhere else. So it's not like inheriting a big stock portfolio where you can just sell some of the holdings to raise the cash. It's a whole different deal. So this is where a lot of breaks for farms, for example, come into play because farms have been passed down generation to generation to generation. The government often wants those types of things to stay in the family. And if the kids are all of a sudden have this big, $400,000 estate tax bill because they inherited the farm and it was over the threshold, that's pretty hard to do. There are ways to plan around it. There are life insurance trusts and all these other mechanisms that hopefully were in place to mitigate some of that tax. But this is where family limited partnerships come into play because for estate tax purposes, there are currently liquidity and minority discounts. And so if you take the $25 million businesses, the $25 million business, and you take 30% of it and you put it in an irrevocable trust that you're still calling the shots on the business, you're still running it, but the trust technically owns the shares. And you take another 30% and put it in the family limited partnership. Well, 30% of 25 million is, I can't do the math in my head. Well, I guess I can, 4.5 million a piece. Is that right? It's Friday afternoon and I can't do that math in my head. But at any rate, the value that you pay tax on is reduced by 30 is reduced because there's a discount for the share being a minority holding. So in other words, if you split up the company in a way where no one share has a majority holding, anything that doesn't have majority voting rights can theoretically qualify for this discount. And so the value of your estate that's subject to these taxes basically goes down by putting the business in a variety of these trusts and family limited partnerships. As you can imagine, this is a heavy move too. This is a substantial thing to do. It doesn't happen overnight, but some of these marketability and minority ownership discounts are potentially on the chopping block. So if, not only is this maneuver likely to either go away or change, the threshold at which it applies is about to be cut in half. Pretty good opportunity to get on the horn with your attorney if you haven't done so already. Now, as an attorney earlier in the week told me, that there are always going to be changes to these estate planning maneuvers, and the stuff that's an opportunity today goes away. That means that they dust off the playbook from the 80s and 90s. The ecosystem kind of changes a little bit, but it goes in cycles to where the strategies relevant to that landscape, that ecosystem and tax law at the time, that stuff just kind of goes in cycles. So the way that he put it was, the stuff we were using back in the 80s, we just dust off and start using that again. It's not like, there's no opportunity to plan from an estate standpoint. So at any rate, if you're concerned about the size of your estate and the amount of estate tax basically your kids will have to pay upon your death, now is the time to have a discussion with your attorney about it, particularly if you own a small business or a big business. Now, the other one that I think raised a lot of eyebrows when it was announced was the changes to Roth conversions of after-tax balances. There are also potential changes to Roth conversions at all. But for most of you listening, those are not going to apply because in order to not be able to, or what's the right way to put this? To be prevented from doing any Roth conversions of pre-tax dollars, you have to have a substantial amount of income and a whole bunch of money in retirement accounts already. So for those of you who are thinking about converting dollars in your pre-tax bucket of money, 401ks, IRAs, SEP IRAs, simple IRAs, if you're thinking about taking those balances, converting them from pre-tax dollars to a Roth account, accelerating the amount of tax, shrinking the pool that's subject to mandatory distributions later, chances are you're going to still be able to do that. What's changing are the backdoor conversion options. So we talked about this a little bit last week, but the backdoor Roth IRA conversion, you put $6,000 or $7,000 if you're over 50 into a traditional IRA. And even though you might not be able to deduct that contribution, currently you put $6,000 in, you have a basis of 6,000. If you convert it to a Roth IRA later on, then you're effectively getting the assets into a Roth IRA. And the reason you do that is you made too much money potentially to put it into the Roth IRA directly. So that conversion of after-tax money, so that second step in the maneuver, moving it, the 6,000 you already paid tax on from the traditional to the Roth IRA, that is what's on the chopping block as well. So what that means for us, and this is the strategy that we need to consider if you're in this situation, if you have any after-tax balances in your IRAs or 401ks, now is the time to make an educated decision about whether or not to convert them. And you don't want to just by default rush out and convert every dollar of after-tax money you have in one of these accounts. Apologies if this is a little bit technical, but there's this other thing that we need to consider called the pro rata rule. So theoretically, if you have two different IRAs, both of them have $6,000 in them. And let's say that account number one, you put $6,000 into, you put it in cash, it didn't grow or fall in value because it wasn't invested, and you deducted that contribution. Well, you have $6,000 in that account and a basis of zero because you haven't paid tax on any of it. And let's say hypothetically in account number two, you put $6,000 into it, it's in cash, but you paid tax on it because maybe you got a different job and had access to a 401k and made over the threshold of income to where you can no longer deduct that contribution. So you have two accounts, one that you deducted, one that you didn't deduct. You don't get to just choose account number two and say, well, this one is the one that I want to convert. I want to move it from the traditional to the Roth IRA. And keep in mind, when you do so, you're paying the tax on the difference between market value, 6,000, and basis of 6,000. Well, you don't just get to carve out that one account. You have to take the relationship of market value across all your IRAs to basis of all your IRAs and multiply that ratio by the amount that you're converting. So if you took $6,000 in this scenario, moved it into a Roth IRA, you're going to pay tax on 50% of it, or $3,000, because the market value is $12,000, the basis is $6,000 when you combine the two accounts. So if you're in the situation where you have after-tax balances, if you have money in IRAs or 401ks, I should say, I'll get to 401ks in just a moment. But if you have money in IRAs that you've already paid tax on, consider converting them now, because after December 31st, it's likely you won't be able to after that point. But your decision point here is not just how much do I have in after-tax dollars, it's how much do I have across all my IRAs. Because if you have other IRAs with the basis of zero, SEP IRAs, simple IRAs, any kind of IRAs, they all contribute in that pro rata calculation. That's going to drag down the benefit of doing such a conversion. So if you have a SEP IRA from, I don't know, self-employment activities, and you have $200,000 in there, and then you have $6,000 of traditional IRA money that you did not, or that you've already paid tax on. Well, if you move that $6,000 into the Roth, you're going to pay tax on like 97% of it, because you have a total value across all your IRAs of $206,000. The only money that you've paid tax on is $6,000 of it. So it's not going to be that beneficial. Now, there's a workaround here. And the best way to describe it is all the money that you did not pay tax on, so it has a basis of zero, you deducted when you made the contribution. There is a way to carve that out of the equation and only focus on the assets that you did pay tax on already, these after-tax contributions. And the way is to roll them into a qualified retirement plan, like a 401k. So if you're working at an employer, so if you're in this situation, you have a little bit of after-tax money you're trying to convert, but you also have pre-tax IRA money that is getting in the way of doing that. One thing you can do is roll that money into a 401k or a 403b plan. And so if you're working somewhere that has a 401k and allows rollovers in, not all plans are not required to do that, but most do, then you roll the assets into that 401k or 403b or whatever, and then you do the conversion after that. Now, there's a technicality here. Apologies for being a little technical here, but the technicality is that you're going to be, the only date that matters is December 31st. And so if you have other assets that come into that IRA, if maybe you take them out of that plan, and on December 31st, you have $6,000 in after-tax money and $200,000 that was in the 401k, but then later came back to the IRA, then that's going to get you in trouble. You have to have those accounts cleared out on December 31st of this year. So if you work somewhere that sponsors a 401k or a 403b, that's one way to fix the problem. The other way to fix the problem is if you're self-employed and you don't have one of those plans already, or if you do, then move those assets into the 401k plan, your own, theoretically, and get it out of there. And if you have a SEP IRA or a simple IRA, might be time to explore a 401k plan for this purpose if you're in that boat. So I went down a rabbit hole there for a minute or two, but suffice it to say that the conversion of after-tax amounts is going away at the end of the year. If you have balances that you've already paid tax on in an IRA or a 401k for that matter, you want to look hard at converting them before the end of the year, but be cognizant of this pro rata issue that I mentioned. Now, a lot more 401k plans are starting to offer Roth deferrals and after-tax contributions through payroll and Roth conversions within the plan. Just like the backdoor Roth IRA conversion might be going away if it's passed and if this bill is passed in its current form, same goes for 401k plans. So it's a lot less likely, I think, that this pro rata issue is going to be a problem within a 401k plan. And so if you have after-tax balances in the 401k plan, you probably want to shovel them over to the Roth 401k option before the end of the year. This also means that if you're a small business owner and have a 401k plan you get to pull the strings on, it's going to make offering Roth salary deferrals that much more important, because there's no income limitation on Roth salary deferrals. If you make more than 197,000, or the number might be a little higher this year, as a married couple, you cannot put money into a Roth IRA. But you can make $10 million a year and still defer $19,500 into a Roth 401k if you're a participant in a plan that has that option. Now, if you're making $10 million a year, I might opt for the break, the deduction on making a traditional contribution, but I guess it's still an option. Now, the other thing that I was going to mention here is, we talked about this last week, tax rates are going to go up by a little bit for high income earners, above $400,000 for single filers, $450,000 for married people filing jointly. And I got a really good question this week after last week's episode aired, which was, where on earth did those numbers come from? Are there actuaries sitting in a back room somewhere calculating how much revenue that would bring into the Treasury Department if we only raise tax for people above those thresholds? Where do 400 and 450 come from? And to be honest, I don't have a freaking clue. But I would suspect that it was probably some Democratic strategist testing answers and campaign promises in front of focus groups to figure out what threshold had the most resonance to potential voters, because that's been Biden's campaign promise all the way through. If you're not making more than $400,000, you're not going to see any difference in taxation. And I suspect that was a campaign promise that was engineered in a really specific way, probably something he didn't have any control over, to be honest. So if you're in that situation where you're making above $400,000 as a single filer or above $450,000 as a married person filing jointly, just like anytime we expect taxation to change, if you have the opportunity to take deductions this year or next year, they will be more valuable to you if you kick them out into next year. Other things equal. Everybody's unique. There are a lot of circumstances where it may be more valuable to you this year, but in general, if your situation is not going to change income-wise, taxation-wise, year over year, the deduction will be more valuable to you then, 22 and beyond, than it will be this year. And on the same note, if you have the opportunity to accelerate income and take it this year instead of next year, which a lot of business owners do, accelerate billing into this year, payroll bonuses, you probably want to kick out until next year, except unless you're bonusing yourself, you would do that this year. You accelerate income, you defer deduction opportunities, because we think the tax rates are going to go up if you're in those buckets, those thresholds. So we covered 5 different maneuvers that are applicable to you, particularly for high income earners, for people who are concerned about their estate taxes, for owners of S corporations, and for anybody with balances in IRAs that they've already paid tax on. So I hope this wasn't too technical, and apologies for doubling up on this issue in consecutive weeks, but this is a relatively big deal, and it's looking Likely that the draft will become law. It's a little premature to jump to that conclusion, but it has a lot of ramifications. So, with all this in mind, if you need to talk to your tax person, if you need to talk to your lawyer about this stuff, get on their calendar now. I was just in a training this last week for exit planning for business owners. And when this has come out, all the attorneys who work on those kinds of deals on behalf of business owners, so people who are trying to sell their businesses and draw up all the legal documents and get the estate planning in place, and there are just a lot of pieces that have to come into alignment for that to happen successfully. All the attorneys that work on that stuff are booked out in full through the rest of the year because this is such a big deal for people in that situation. So if you need to talk to your person, your guy or your girl, tax, estate planning, whatever, I'd get on their calendar sooner rather than later because of the importance. All right, that's it for now. Have a good week, everybody. Thanks for tuning in.
Thanks for tuning in to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Be sure to subscribe to the podcast on iTunes, Google Play, or wherever you digest podcasts to ensure you don't miss out on future episodes and announcements. And feel free to submit questions to growmoneybusiness.com.